Hello, income harvesters and income investors. Welcome back to the Harvesting Income channel. Today, I'm going to talk about an interesting fund which is known as the CANY or the Evolve Canadian Equity Ultra Yield ETF. This is from the Evolve ETFs. So they have launched this fund which is providing high monthly income and it focuses on investing in the Canadian companies, but at the same time using option strategies to generate that high income. So this is a fairly new fund launched recently, so I'm not going to go through the website. I have actually compiled the information together, so I can talk to you about two things. One is about the CANY ETF and how it works, what are the strategy, what are the features, and also compare that with HHIC, which is the Harvest ETF, which is similar, and we will get to know how these two funds compare with each other. These are new funds, so we don't have much of track record. So before I go ahead, a quick disclaimer: whatever you're seeing here is just for information and understanding the funds and getting knowledge, not a financial or investment advice. So with that, let's get started. So what's in this fund basically? It invests in the leading Canadian companies, blue chip Canadian companies, banks, large resource companies, utilities, communication companies, and so on. So that's the first thing that you need to know. Like you are investing in these large companies. I will show you the portfolio as well. So that's number one. That's going to be your underlying portfolio or underlying assets. The second would be the covered calls. The fund employs covered call strategy on half of the portfolio, like 50%. So you have one half which is like uh, stocks with the covered calls. The other half like just the stocks you're going long on those stocks. So you have a mix of both. Like I would say this is similar to the previous, XYLG, like from the Global X. Although these two funds are not exactly comparable, the 50% concept works similarly. Like half of the fund is, exposed to covered call writing. The other half is just buy and hold. So you have a growth potential in the half where the covered calls are not written. Like you have full upside. On the other side, you also have income due to the covered call writing. So you have a balanced approach, kind of 50% of portfolio is used for call writing. And the leverage, the third part. The fund uses modest leverage of 33%, which is like up to 1.33x. Now, there are funds from Harvest and others who write 25% leverage. This fund is going up to 33%. Like they may not do 33% full all the time. So they can go up to 33%, which means that they can increase the leverage when the market conditions and certain opportunities are attractive. And when the time is right, they can increase that leverage. And leverage will enhance your returns. However, at the same time, when the price falls or when the fund is not performing well, the leverage can magnify the returns on the negative side as well. So that's something you need to keep in mind. So with that, those are the three main, features of the fund. Let's get to the next area. And what is the portfolio? So I mentioned these are the large blue chip companies. If you hear all these names, often in the media or in the news channels, YouTube, and so on. And these are listed on the Toronto Stock Exchange. All these big ones like Chemical, Brookfield, RBC, Shopify, and Bridge, BMO, Bank of Nova Scotia, Canadian Pacific, Thomson Reuters. All these are pretty well-known names, and you have these the weight across these different names. Roughly, they have 10 stocks, and probably this could increase. This could change in the future. Probably they may increase it like they have more, opportunities or more stocks to add. They might increase it. But as of now, we have 10 companies. And when you look at the sectors, like it is basically the four or five sectors which are and dominant here. You can see the financials, 50%, and then followed by communications and basic materials. And then you have energy and industrial. So that those are the sectors the fund is investing in. And yeah, so all this information is from the fund website, Evolve ETF. So if you want to know exactly the details of what companies they invest in, what are the fees of the fund, etc., you can go to the website. They have all the information. I'm going to give you a quick summary here. And let's look at the key metrics. The ticker symbol is CANY, CANY. So just to make it sound like Canadian, they made a name like this, CANY. So, and it's listed on the TSX. And currency unhedged to CAD. Basically, it is not hedged, but it is in Canadian currency and it has been converted to Canadian, but it's not hedged, meaning there is some foreign currency risk. So when the US currency appreciates, you will benefit. And when the US dollar depreciates, you're going to, you know, have those adjustments. So I'm not sure how exactly that works, but that's what it says here in the fund information. The price is about $25.35. This is as of September 23rd. The fund was launched pretty recently, 1 week ago, like on the 17th of September. So there's not much of history to go by. Like we don't have much of history, so it's too early to make any judgment. We're just trying to, just peel the onion and understand what are the different aspects of the fund and keep an eye on this one because this is very interesting for various reasons. I'll come to that. So as we go to the end of the video, I'm going to compare CANY and HHIC, Harvest High Income Canadian Shares. So which is also in the similar space. Previously, I covered the Harvest High Income Shares, which is focused on the US companies, but now they have the Canadian version, HHIC. So that's something you need to be, aware of. You can look into that fund as well. Management fee is 0.4 percent plus taxes, and it seems modest compared to other types of funds. I think Harvest also has a similar kind of management fee, and these are new funds. Like we still need to wait and see how the total expense ratio will pan out. So as of now, it looks reasonably good and not that expensive. For a covered call ETF, it's not that expensive. Now, coming to the main area that you're interested in, the distributions. The fund distributes twice a month, just like you get a paycheck like every 2 weeks, or sometimes you get semi-monthly, the middle of the month, end of the month, something like that. So they're going to pay two times in a month. For the exact dates and details, you can go to the website and see that. They have given a rough number that estimate that it should be around 21 cents per unit. And if I do the calculation, it comes to around close to 19.9 or 20%. But I feel that distribution can be around 18 to 20% roughly per annum. So that's just an estimate as of now because the fund is new. So this is not based on the historicals. This is based on future projections and highly variable. So do your own due diligence. Like this is not a recommendation, but it seems to be that it will be in the high teens or or even 20% or more sometimes. That's because there is a leverage and that could boost your yield. Okay, now coming to the most interesting and the last part where I'm comparing this fund with HHIC. Let me quickly show you that fund as well. Like this is the HHIC that I was referring to, Harvest Canadian High Income Shares, and which you see on the right side. I will just bring it to the left so you can see that clearly. Just make it full screen. So this is the fund I'm going to compare with the Evolve fund, CANY fund. So the ticker symbol is HHIC, and it's the Harvest Canadian High Income Shares. And when you look at the portfolio breakdown, I'm going to click on that. So you have again a bunch of stocks. Like most of the names are familiar, 10 stocks here. So you see these stocks which are really popular names in the Canadian market. Let me bring it a little bit on the left. Yeah, so this is the portfolio. Now I'm going to compare it, in a separate, sheet table that I have shown you. So that will give you a better view instead of trying to, toggling between the screens. So yeah, so here we have the table where you can see the comparison. CANY is the Evolve Fund and HHIC is the Harvest Fund. So when you look at the inception, it's not much different. CANY came in the middle of September and HHIC around middle to end of August. And portfolio is also similar, like Canadian companies, then and again similar portfolio, but the exact stocks are different. So you may want to check the holdings, like if you're very picky on the exact stocks that you want to pick. Look into that. Evolve has more exposure to financials, is what I observed, but I need to still dig into the deeper aspects to see exactly how they have allocated and what are the differences between the portfolio. But it's more or less similar. But CANY has a higher weightage on the financials side, like bank and financial companies. And strategy is the same, more or less, covered call strategy, but there is a minor difference. In CANY, they are allowed to write about 50% of the portfolio, like about 50% of the portfolio has to be used for covered call writing. It can be on or around 50%, like it may be slightly more, slightly less, but around 50% of the portfolio. However, if you come to the HHIC, the right side, they say it's up to 50% of the portfolio, which means they are giving more flexibility for the fund manager to decide how much of covered call writing they want to do. So the exact number has not been specified. Like it could be anywhere from 0 to 50%. And what would be that range is difficult to say. And that would be, variable, dynamic. In a way, it's good, but when the markets are doing well, when everything is perfect, and so you don't have to compromise on the upside. So covered call funds are known to compromise on the upside or sacrifice the upside because of the covered call writing. So if you have the flexibility to write lesser number of calls when the market is rallying, in that case you are able to capture the full upside of the markets, bull markets especially. So that makes it more interesting on the harvest side. So harvest has that benefit of flexibility. In Canny or Evolve, that flexibility is pretty less. But there is one good thing about Canny is they have the leverage. They can do more investment, more. They can buy more stock. They can write more calls. So that's the slight edge that they have. And leverage can actually, be good and bad, both depending on how it is. Anyhow, uh, if the returns are negative, leverage can be bad. But if the returns are positive, you will be able to boost the returns. So management fee is more or less the same for both. We'll have to wait for 1 year and see what the expenses are. Leverage, I said, is higher on the canny side, and so canny might tend to give you more yield um, in a good market because the leverage is high. But when the markets are down, they might also, you know, provide negative returns. Like that's so it's a double-edged sword. And harvest is actually 25% leverage, so it's more modest for harvest. So that's about the leverage. Now, the interesting part is the distribution. I think the exact timing of the distribution of frequency should not matter, but if you are someone who's looking for cash flows or you want a regular payout schedule, like you might prefer CANY because they pay the distribution twice a month, whereas HHIC is paying every month, once every month. So, so that could be another factor that you want to look into. Like if you want to receive more cash on your portfolio so that you can reinvest or you can invest back into the same fund to increase your cash flows. So whatever goals you have as an income investor, like you may have some goal to hit a certain amount of income every month. So in that case, higher distribution can help. Or if you want something like more stability, but you're not concerned too much about the frequency, as long as you get the monthly dividend and the NAV is stable, you're fine. That's another option. Like both have its own pros and cons. So by looking at all this, I would say that both funds are equally good. I would say that Canny has a slight edge in terms of the leverage, and also they might be able to attract all these uh, pure income oriented investors because of their distribution frequency and also high leverage. But someone who is looking for a lower amount of risk and a modest leverage, someone who is looking for a monthly kind of payout would move towards Harvest HHIC. Both have similar kind of portfolio, but Harvest has a more diversified one as of now. But I don't know if this could change in the future. as the funds evolve over time. So I hope you like this video on the new format. And if you have any questions, any comments on these funds, or if you have any other observations that you have seen of these funds in the recent times, please share your comments below. Look forward to hearing from you. Happy investing. Have a great day.